Hi, good morning, friends. So, today's episode is going to be accounting for leases. As all of us know, the new accounting standard Ind AS 116 is going to be applicable effective 1st April 2019. Now, this accounting standard is going to supersede the old Ind AS 17 and the corresponding SIC 15, 27 and IFRIC 4 effective 1st April 2019. Now this is the second standard after revenue recognition where both US accounting body as well as the international accounting body came together to align the accounting standard to ensure the same accounting standard is applicable across the globe. The corresponding IFRS for this accounting for lease is IFRS 16, which was effective from 1st of January 2019, and the corresponding US GAAP for lease is ASC 842, which is effective 1st January 2019 as well. Now the next point which comes to always in mind, why there is a requirement of a new accounting standard for lease when we had an old lease standard. So before getting the answer to that particular aspect, it's very important to understand the importance of lease. So to put it simply, the very basic objective why people go for lease is obviously to have an access to asset. This is an indirect way of getting finance, and more importantly for the organization, it reduces the entity's exposure to asset ownership. Okay. So primarily these are the objectives or the importance of lease. Now most of you recollect, lease is primarily divided into two parts: operating lease and financial lease. As all of us we know, so far whatever we understood, in case of a finance lease, the lease is always accounted in the balance sheet. So which effectively means the asset and its corresponding obligations is always being recorded as an asset and liabilities in the balance sheet. So that keeps a clear understanding what an entity owns as an asset and what an entity owes to the outside as an obligation. Now coming to the operating lease, as most of us may know, if a lease is identified as an operating lease, the expense that's being paid out of this lease is being directly recognized in the profit and loss account of the company. There is no balance sheet as far as the asset and obligation of this lease are concerned. So as a reader of the financial statement, when I look at an entity and I don't look at the asset and the obligation they have got as far as the lease is concerned, it technically doesn't give me a good indication of the financial position of the company. So that is why this model was criticized for failing to meet the needs of the user of the financial statements because it did not provide a faithful representation of the leasing transaction. As we discussed, it did not require lessee to recognize assets and liabilities arising from an operating leases. So now this new lease, as we said, which is aligned in both IFRS as well as US GAAP, which is Financial Accounting Standard Board, FASB of US, and IASB, which stands for International Accounting Standard Board, initiated a joint project to develop a new approach. Now, the very basic objective of this approach, as we understand the shortcoming of the operating lease, which never goes to balance sheet, the very basic objective of this particular lease standard was somehow bring these lease assets and its obligation to the balance sheet so that we understand the financial position of the company. So that is why both the boards they decided that a lessee should required to so both the board decided that a lessee should require to recognize the asset and liabilities for all leases, with limited exceptions, of course. And both the boards have defined the lease in the same way. Both the board there is similar decisions regarding the measurement of lease liabilities and how to account for lease that were formerly classified as financial lease. As far as the lesser accounting is concerned, no substantial change from the existing accounting because it was already being recognized the way it is supposed to be recognized. So now the next thing comes always to mind. What is a lease? Now broadly, and to put it in a most simplistic way, lease is always a contract which have right to use, and it has to always be for a period of time, and there has to be a consideration. Three basic objectives. It's a contract which conveys the right to use an asset for a period of time in exchange of a consideration. So if I break this above definition, a contract can contain a lease when an asset is identified. So you need to have an underlying asset to make it a lease. There has to be a right to control. I repeat, there has to be a right to control the use of identified asset. For what? For obtaining all economic benefit from the use of the identified asset, and very, very important, this is both, and direct use of the identified asset. So just to summarize in a view, there has to be an identified asset. If there is no identified asset, there is no lease. If there is an identified asset, the next test we need to do whether I am going to get the substantial economic benefit out of this asset. If answer to that is no, there is no lease. If it is yes, then I need to put whether we have the direct. Does the customer have the right to direct the use of the identified asset throughout the period of its use? If answer to that no is no lease, if answer to that yes is lease. So that's how a lease has to be defined. So to put it very simply, there has to be an identified asset, right to obtain the economic benefit from use has to be there, and directing the right to use is extremely critical. So once all these three conditions have been satisfied, a particular contract will be considered as a lease. Okay, so next we will go to the objective of this standard. Now, as far as this lease standard is concerned, broadly in a simplistic way, we can define into four various objectives. One, we will understand the way the leases are to be recognized. Second, the way the leases has to be measured. Third, the way the leases to be presented. And finally, what are the disclosure requirements. Before we go into the details, let's also understand what are the various kind of leases for which this particular accounting standard is not applicable. As we know the general concept of the accounting standard, if there is a particular accounting standard available for a particular type of transactions, the specific accounting standard will not be applicable to that particular standard. Similarly, IND AS 116 is not applicable for minerals, oils and natural gas extractions. These are not applicable for biological assets because it's been covered with IND AS 41. Not applicable for service concession arrangements. That's part of the scope of IND AS 115 appendix to IND AS 115. Which talks about the service concession arrangement in great details. This is not applicable to licenses of intellectual properties, which is also in the scope of IND AS 115 which is revenue from contracts with customers. This is not applicable right held by a lessee under licensing, which is covered under Ind AS 38 on intangible assets. Now, in all the scenarios, Ind AS 116 is not applicable. Now, the next point comes, this accounting standard also exempts certain type of leases which need not follow this accounting standard, as it's a comprehensive accounting standard, and as we discussed in the beginning of the video, which talks about bringing into the asset and the obligation to the balance sheet. So broadly, it exempts two types of leases. One is if the leases are short term. Second, leases where underlying asset is of the low value. Now we have to be slightly careful when we take care of this exempted lease. Now, how do you define short term? Now, it's very, very critical, and it differs from organization to organization, from the type of leases to type of leases. So, it's extremely important to do the understanding while defining the short term. So, generally, short term is being considered where the lease period is less than 1 year. However, in many other cases, even if the lease term is more than 1 year, but there are some other conditions, then also it is being qualified as a short-term lease. Let us take a simple case study. Let's say lessee L enters into a 10-year lease of a machine to be used in manufacturing parts for a plane that it expects to remain popular with consumers until it completes development and testing of an improved model. The cost to install the machine in L's manufacturing facility is not significant. L and lessor M each have the right to terminate the lease without a penalty on each anniversary of lease commencement date. So in this case, if you analyze, the lease term consists of a 1 year non-cancelable period, right? Because every year they have got a right to cancel that particular lease. And both the lessor and the lessee, they have got the substantive termination right. Both can terminate the lease without penalty. And the cost to install the machine is also not significant. Now, this is a typical case where this particular lease can be considered as a short-term lease exemptions. Now, let's go to the next point. How do I consider which one is low value? Now, there are two things which we have to be very, very careful when we define what is low value. Now, broadly, as a layman, I can use two conditions. The condition number one, the lessee can benefit from use of underlying asset on its own or together with other resources that are readily available to lessee. So, benefit from use is very, very important. What is condition two? This asset is not highly dependent on. This asset is not highly dependent on. Now we have to have a word of caution when we decide on the low value. A lease of an underlying asset doesn't qualify as a lease of low value asset if the nature of asset is such that when a new asset is typically not of low value. For example, car. When you replace a car, the new car value is obviously not a low value. So in that case, we have to be extremely careful when deciding what exactly the underlying asset and when exactly the underlying asset will be considered as a low value. Now, having said this, so once we identify a lease is either a short term or the underlying asset which has been identified is of low value, this falls under exemptions to Ind AS 116. So which effectively means the revised accounting which has been identified, this is not to be followed if the leases fall under either of these two categories. So then how do we account it? The accounting treatment is going to be exactly same the way it was done in the old accounting standard, Ind AS 17, or the elsewhile accounting standard 19, which talks about either you account it on a straight line basis or there is some systematic basis which gives a periodical accounting of the lease expense in your P&L. Okay, so now we will go to the concepts of the lease what we discussed. As we discussed broadly three concepts. Asset has to be identified. The right to use of the obtaining the economic benefit has to be there, and direct or the control the use of that particular asset. Now let's understand few minute concept in this. Now in identified asset, it's very important. So let us take an example of another concept called as substantive substitution right. Now if the supplier has practical ability to substitute alternative assets throughout the period of use, and the supplier would benefit economically from the exercise of its right to substitute the asset. If both the conditions are applicable, then this is not a lease. So let us take an example to make it clear. Let's enter a lessee entered into a 5-year contract with a freight carrier to transport a specified quantity of goods. The lessor uses rail cars of a particular specification and has a large pool of similar rail cars which can be used to fulfill the requirement of the contract. The rail cars and the engines are stored at the lessor's premises when they are not being used to transport the goods. Cost associated with this substituting the rail cars are minimal for him. Now if you analyze this case, just because the rail cars are stored in lessor's premises, it has a large pool of similar rail cars and substitution costs are minimal. The benefit to M of substituting the rail cars would exceed the cost of substituting the car. Therefore, here the substitution rights are substantive and it is economically benefiting the supplier. So that is why this particular arrangement will never contain a lease. So it's very important to understand. Now the second component comes when a portion of asset is being leased. So there are two fundamentals, and very important fundamental is when a portion of asset is being leased, what's more important is the capacity portion of an asset is unidentified asset if it is physically distinct. Very important. If it is not physically distinct, that will never be classified as an identified asset. For example, a floor of a building is a physically distinctive asset. If I am not able to identify it distinctively, that will never be considered as an identified asset. Now let's go to the second concept, right to use of the economic benefit. Now when I am going to test the use of economic benefit, the economic benefit not necessarily need to come from that asset. It can come by using of that asset. It can come by holding of that asset. It can also come by subleasing the assets. It can come the output of the assets. It can come by the byproduct from the asset. Or it can be other economic benefit using that assets, which can be realized. Now another very important concept which has to be understood when identifying the economic benefit of the use is it has to be within the defined scope of a customer right of the use of the asset. Now let's take a simple example to understand this. Let's say there is a contract where a company is leasing a car And in the contract, it is clearly defined. This particular car can be used within a particular territory or a particular state. Now, when we look at the economic benefit, an entity shall consider only the economic benefit from the use of the motor vehicle within that territory and not beyond. Even if the car is being used outside, we should not look at the economic benefit of the car out of the territory which is beyond the contract. Same thing may be applicable. Let's say the same contract where a customer can drive a motor vehicle only up to a particular number of miles. So in that case, an entity shall consider only the economic benefit from the use of the motor vehicle for a permitted mileage and not beyond. Now the last part is right to use of the asset. Let's understand in a systematic approach in a decision making tree. So now very important to decide who has got the right to use. First question we need to ask, who has got the decision making power, how and what purpose this particular asset to be used. If that decision making power is with the customer or the lessee, then it's a lease, absolutely no doubt. If the decision making power is predetermined, then ask the next question, whether customer operates the asset or customer designed the asset. If no, there is no lease. If it is yes, there is a lease. If the decision making power on how and what purpose to be used is with the vendor or the lessor, there is no lease at all. So just to summarize, three concepts. One is there has to be an identified assets. While understanding the identifying asset, we have to also take into consideration the substantive substitution right. Obviously, if the supplier has got the practical ability to substitute an asset and the supplier would benefit economically, that will not fall under lease. If there is a portion of asset, that capacity portion is an identified asset only when it is physically distinct, like the floor of a building. If it is not physically distinct, this is not a lease at all. Right to obtain economic benefit is next important things. The economic benefit may come either using or holding or subleasing the asset. It may come primarily out of the asset, it may come from the byproduct, it may come from the other economic benefit of the asset. The restrict to the scope of the customer right is extremely important. We gave an example of motor vehicle restriction used in a particular state or up to a particular kilometer, that has to be looked into. Now, right to use, the direction. It's important to understand who has got that decision making power. If customer has got the decision making power, it's a lease. If it is predetermined, then we need to see whether customer operates that asset or design that asset. If answer to that yes, it's a lease. If answer to that asset is no, it's not a lease. If it is defined by a supplier, obviously it's not a lease. So having known how to identify the lease and what are the parameters to identify the asset, the economic benefit and the control who uses the lease, now we can go to the next step in the accounting standard on the accounting part of the story. Now first let's understand the lessee books, and it's extremely critical because this is the way where the standard got changed. Lessor books is by and large is similar, or no change in the new accounting standard. Now broadly I can divide into three parts. One is how do I recognize, how do I measure what value I have to recognize, and what happens in case of a modification. Now as we discussed in the beginning of this video, in this new accounting standard in the books of lessee, we are going to recognize the asset, which is obviously the right of use, and the liabilities. When I measure it, I have to measure it initially, so that's at the beginning of the lease, and what should be our subsequent measurement. Now the question comes to a mind. Obviously the recognition is pretty simple, one asset and one liabilities. Asset will be right of use of the asset, liabilities will be lease liability, pretty simple. Now the question comes, what value I am going to recognize? The measurement is going to play a very, very important role in this standard. Now let's spend some time to understand the measurement. Now obviously when I take a lease, there will be multiple things which comes into the measurement factors. There has to be a lease liability. When you take a lease, there has to be a consideration. Obviously, we call that as lease liability. There may be leases where I prepaid certain lease amount, I pay in advance. There may be some initial direct cost which may involve in that lease. And there may be some estimated cost or the contract which says when I am going to leave the lease after a few years, I need to bring back the property into the same condition. So obviously you are going to incur some kind of cost at that point in time. So in Ind-AS 37, we talks about how do you recognize that in the accounting. So it's very, very important. We also consider that as part of this lease cost as well. Now it's very important to understand this lease cost, since we are accruing the entire liability at the beginning of the lease and we are recognizing the asset, the entire story has to happen with the present value. Why present value is important? As we understand the concept of time value of money, the lease payment which I am going to pay probably 3 years from now is not exactly the same value stands today because of time value of money. So when I recognize a liability or asset as on today's date, it's extremely important we understand what is the present value of that lease. So that I recognize in the books. Rest everything between my present value and the cost, what happens at that point in time is the element of interest or finance cost. So now when I discount it to present value, I should consider the interest rate implicit. Or if it is not available, I can also consider the incremental borrowing rate. So let us take a simple example to understand this. Let's say in year 0, company X given a 3-year lease, the lease rental is 10,000 rupees per year to company Y. There is no other cost involved. And the discount rate let's say is equal to 5%. So now how do we account in this case? Now as we said, this is a lease. There is an underlying asset. Economic benefit is being used. The control of the lease is with the company Y. So first testing is lease is yes. Second is I have to recognize an asset and an liability. Then I should go for measurement. So how do I measure? On what value I have to recognize? Now as I said, so here it is pretty simple. So I have to pay year 0, year 1, 10,000, year 2, 10,000, year 3, 10,000. Now this is my total lease expense, but as we said, we need to get the present value. So now year 3, whatever 10,000 in year 1, that is not 10,000. So obviously I need to discount it. For discounting it, in this case, they have given the rate as 5%. So if I discount this 10,000, 10,000 and 10,000, so what I will have? 10,000 divided by 1.05, 10,000 divided by 1.05 oblique 2, 10,000 divided by 1.05 oblique 3. So now I will arrive at a number of close to 27,232. So this is nothing but my present value of lease expense or lease liability and asset which has to be recognized, right? The present value of the lease asset and liabilities. So now let's go to the journal entry. What journal entry I should pass to account that in the books of lessee? So So now we understood how this 27,232 came in, which is nothing but the present value of the lease liability. Now let's go to the accounting. Now in the initial recognition, I have to create a right to use of the asset for 27,232 and 27,232, right? So I'm creating an asset and I'm creating a liability for 27,232, 27,232. Then subsequent years, now this asset has to be depreciated. For the time being, I'm assuming I'm following a straight line method of depreciation for 3 years. So every year I have to depreciate 9,077 rupees, which is nothing but 27,232 divided by 3. There is a finance cost element, obviously, because I have a liability of 27,232, which I am paying at the end of every year. So assuming 5%, so there is a finance cost. And my lease liability, which is accounted 27,232, every year I have to pay 10,000 rupees. And I know I am paying finance cost 1,362. So the differential figure is lease liability debit. And obviously every year I will pay cash of 10,000. And this depreciation what I am accounting, that obviously has to reduce my asset. So if I prepare a profit and loss account, so what's going to happen in profit and loss account is depreciation will get accounted 9077. Finance cost will get accounted as 1362. In balance sheet, I have an asset 27,232. I will reduce depreciation of this. I have a liability of this. I will reduce the payment what I have made it. So obviously this number and this number will balance it. Same thing will happen in year 2. Same thing will happen in year 3. So in year 3, what's going to happen is your asset will become 0. Your liability will become 0. And if I look at the P&L for all these 3 years, my P&L technically will come in that 30,000 rupees, which will broadly be divided between my depreciation and finance cost, right? So what is happening in summary? Earlier it used to be the entire P&L of 30,000 going as lease rental. Now what changes is, this accounting standard is trying to understand whatever you are paying lease rental, there is an element of finance cost in that lease rental, obviously, because you are not paying on day one everything. So that element of finance cost, it's try to bifurcate it. And it is showing separately as finance cost. Obviously your lease, whatever lease rental, that goes as a depreciation because you are recognizing as an asset. So broadly the same thing is being divided into 2 parts. One is coming through on account of depreciation, second is coming on account of financial cost. So in this case, with the substance of the transaction, though it is a lease, though I am paying as a rent, there is a hidden element of interest cost or finance cost, and there is a hidden element of depreciation which was never coming to the face of the profit and loss account. So through this process, your depreciation is going to come in your P&L and your finance cost is going to come your P&L. So the user of your financial statement is going to have a better information to understand between your depreciation and finance cost rather than putting it together as a lease rental expense. Now I will not complicate at this stage since we are recognizing as an asset and liabilities. Accounting standards of related to asset and liabilities are going to apply. For example, cost model, for example, the impairment of assets, subsequent measurement of lease liabilities, if there are any negotiation which is changing your lease liabilities, if there is a change in discount rate. Now all this factor is going to impact the lease as well. If there is a negotiation to your lease, now all this factor is going to impact your lease as well. Now we will not discuss in this video in detail about this because those are purely technical in nature and this is not applicable to majority of the lease unless until really there are specific changes. So that can be probably debated or deliberated when it comes to that specific. So now that we understood the accounting in the books of lessee, now let's understand the accounting in the book of lessor. Now I will not spend a good amount of time here because not a substantive change with the old accounting standard, but just to put it simply, the accounting in the books of lessor broadly involves the classification of lease, the initial recognition, both initial as well as subsequent measurement, and obviously if there is any subsequent modification. But the most important factor here is to identify the lease, whether it's a financial lease or operating lease. Now that defines the accounting treatment of the lease. Now to understand what's a financial lease, if I just read through the definition, it talks about if it transfers substantially all the risk and rewards that is incidental to ownership of an underlying asset. I repeat, if it transfers subsequently all the risk and rewards incidental to ownership of the underlying asset is called as financial lease. Now the lease which is not a financial lease, obviously that is operating lease. Now the question comes, how do I identify whether a lease is a financial lease or not? Because it's very simply being written, the ownership is being transferred. So now to understand what's a financial lease, there are 5 basic conditions. If one of the conditions gets satisfied, then it will be considered as a financial lease. So the first condition is the lease transfers the ownership of the underlying asset to lessee by the end of the lease term. Now, if there is a condition by end of this lease term, the lessor transfers the ownership of that particular asset to lessee, then that becomes a financial lease. Nothing else to be tested. The second condition, if the lease has got an option where it gives a power to lessee to buy that asset at a value which is lower than the fair market value at that point in time, that's a financial lease. The third, if the lease term, the duration for which we are entering into a lease, which substantially covers the life of the asset, obviously that's a financial lease because you cannot use that asset anywhere else. The fourth, which is very, very important, the lease amount that's being paid by lessee to lessor, the present value of the lease amount is substantially covering of the fair value of the asset. That's also a financial lease. Fifth, if the underlying asset is of a specialized nature, that asset can only be used by lessee without major modification being made, obviously that's a financial lease because that cannot be used by anybody else. Now, if one of these 5 conditions gets satisfied, obviously that lease is a financial lease, there is no doubt. Now, we may have situations where it may not be possible easily to identify one of these 5 conditions to that lease. So in that case, there are few suggestive situations where it can be looked into. So now we have to be careful. Now the 5 conditions what I said, that is must. If one of the condition is getting satisfied, that lease contains the financial lease. We need not test anything else. But if I'm not able to identify one of those 5 conditions, if any of these 3 conditions falls through, probably it can be debated as a financial lease. It's still not 100% sure that has to be a financial lease. What are those conditions? Now, if lessee can cancel the lease, however, if there is any loss which is associated with the cancellation of the lease has to be borne by lessee, then it may be a financial lease. If there is a fluctuation in the fair value of the asset, any gain or loss that's arising out of that loss, loss is on account of lessee, then that may be a financial lease. If lessee has got ability to continue for the secondary period of the lease, like the lease is for a particular period, the lessee has got an ability to continue it for another round of period with a lease rent which is much lower than the market rent, that may fall under financial lease. As I said, I repeat, the 5 conditions what we discussed earlier, those are must for determining a financial lease. If one of these conditions gets satisfied, that lease will become financial lease. If it doesn't, we can test for these three, then that can be debated whether the lease is a finance lease or not. So now once a lease is being identified as a finance lease, the second comes, how do I account this lease? Now, since it is a finance lease, the underlying asset of a finance lease is also considered as a financial asset. Please remember, if it is a finance lease, the underlying asset of that particular lease is also considered as a finance lease. So which effectively means Ind AS 109 coming into the play. So all those things related to Ind AS 109 will be talked about, will be discussed for the accounting of it. So which effectively means there is no physical asset in this lease as far as lessor is concerned. So what is the asset here? Receivable, which is a financial asset. I repeat, since this is a financial lease, the underlying asset for this particular lease in the books of lessor is going to be a financial asset, and 109 is applicable. So the asset which has to be recognized is the receivable which has to be recognized. So now the question comes, at what value this receivable to be accounted? This receivable to be accounted as a net investment value. What is net investment? Nothing but the gross investment which has to be discounted at a present value, which is at the interest rate. Now what is gross investment? Is nothing but the lease payments at its present value. Whatever lease payments I am going to receive throughout the period of the lease, that's basically the gross investment. And if there is any unguaranteed residual payment which will be made at the end of the lease. So that is gross investment. If I discount that, that becomes net investment, and that is the value which I am going to account. So just to summarize in a very, very simplistic way, we need to de-recognize the asset. There is no asset as far as the finance lease is concerned in the book of lessor. So what is the asset here? The finance lease receivable is my new asset, which is a finance asset, and that has to be done, the evaluation, the entire thing has to be done as per Ind AS 109, which is for the financial instruments. As far as profit and loss is concerned, we have to recognize that as a finance income on the receivable based on the interest which we received. Now, if it is an operating lease, fairly simple, the old method of accounting will continue. Asset has to be presented as an asset. The only change is if there is any direct cost at the initial of the lease, that has to be added to the carrying value of the asset. Now, obviously, there is a lease income which is going to come from lessee that has to be recognized on a straight line method, same as the old accounting standard. And there is an expense to the depreciation of the asset on a systematic basis, the depreciation to be charged to the P&L. So that's how, in summary, the accounting in lessor's book. Now coming to sublease. Now sublease we need not discuss in detail. Obviously, all the leads, whatever we discussed so far, is going to be applicable for subleases as well. The same standard has to be tested and applicable for the subleases as well. Now coming to the last part of the standard is the disclosure. Now as far as disclosure is concerned, now this disclosure has to be done both from lessor side as well as lessee side. Now as far as lessor is concerned, be it financial lease or operating lease, both qualitative and quantitative disclosure is extremely critical. Now the lessor shall disclose the following amount which has to be in the reporting period. Obviously the selling profit and loss account, the finance income or net investment in the lease, and the income related to variable lease payment if any. From qualitative and quantitative explanation, the lessor has to give a significant changes in the carrying value of the assets or the net investment in finance lease. The lessor also has to give the maturity analysis, which clearly talks about the maturity analysis of the lease payment receivable, showing the undiscounted lease payment to be received on an annual basis for a minimum of each of the first 5 years and total amount for the remaining years. Now, a lessor shall reconcile the undiscounted lease payment to the net investment of the lease. As we know, the difference is nothing but the discounted price. And as we discussed before, since these are all assets, so lessor also apply the disclosure requirement which is there in Ind AS 36, Ind AS 38, Ind AS 40, Ind AS 41, which are subject to the operating leases. They have to also disclose the maturity analysis of the lease payment, showing the undiscounted lease payment to be received on an annual basis for a minimum of 5 years and the total amount for the remaining period of the lease. And if there are any additional qualitative and quantitative information about the leasing activity that the lessor feels has to be disclosed, that has to be disclosed. Now similarly from lessee side, broadly 3 types: quantitative from balance sheet, profit and loss, cash flow and others; qualitative, and if there is any additional disclosure required. Now lessee shall disclose the depreciation charges for right of use of asset, interest expense for the lease liabilities, any expense of short term, expense related to low value asset where we got the lease exemptions, income from subleasing, if there is a subleasing, the right of use of asset that has to be gone, cash outflow for the lease, additional right of use of asset, gain or loss arising from the sale or lease back transactions, and the carrying amount of right of use of asset at the end of reporting period by class of underlying assets. With respect to investment property, Ind AS 40 will be applicable. Obviously, the disclosure requirement of Ind AS 40 to be disclosed. If the lessee measures the right of use asset on revalued amounts, Ind AS 16 and appropriate disclosure, which is being defined as per Ind AS 16, to be applicable. Similar to lessor, here also maturity analysis to be done for the lease liabilities, applying Ind AS 107 on financial instruments. And obviously, if there is any additional qualitative, quantitative information, that has to be given here as well. And if, as we discussed in the beginning, there are 2 exemptions, short-term leases and low-value assets. If that is being recognized and it has taken the exemption, we have to consider the fact as well. So that's very, very important. Now, having understood the standard, it's extremely important when this standard is going to be effective from 1st April 2019. What will happen to the leases which are already classified as operating lease with this change in accounting? So that is why there is a transition provision in the standard. It talks about the procedure that's being followed to do that. Now this standard gives us 2 options. One option is to do a fully retrospective, which effectively means consider this operating lease as per this new accounting standard from the beginning of that lease. Obviously you have to follow the Ind AS 8, which talks about the retrospective for a reporting period, how exactly the accounting changes happens. So Ind AS 8, which is slightly cumbersome. So that is why the standard also gives an option, the simplified approach, and I call them as modified retrospective approach. So where it says, if a lessee elects to apply simplified approach, the lessee shall not restate its comprehensive statement or profit and loss statement. Instead, it recognizes the cumulative effect of the initially applying this standard and do all this adjustment in the retained earnings. Now, Ind AS 16 doesn't require a full retrospective application in accordance with Ind AS 8, but allowed simplified approach. It allows simplified approach. So now in the book of lessee, what it has to do, as I said, the only change which has happened, if you look at it in the lessee book from an operating lease perspective. So very simple, we have to recognize a lease liability and a lease asset or right to use of asset. Now the lease liability to be recognized, which is previously classified as operating lease, and how it has to be measured? It has to be measured with the present value of the remaining lease payment, discounted using the lessee's incremental borrowing rate. And how I should recognize the asset? The asset is nothing but the liability amount at the date of initial application, previously classified. The lessee shall choose on a lease by lease basis. And please understand, this has to be recognized on lease by lease, not on overall basis on a company. And if a lease is previously classified as a finance lease, the carrying amount of lease liability at the date of initial application shall be the carrying amount. So obviously finance liability, there is no change. So whatever carrying amount I was carrying as per the initial recognition is going to continue the same thing. And the asset is also going to continue in the same thing. A lessee is not required to apply the new lease accounting model to lease for which lease term ends within 12 months. We discussed as an exemption, if a lease term which ends in the 12 months from the effective date of this particular standard, which effectively means before 31st March 2019, we need not go through this model at all. Okay, and Raipur is a classic example for us. So from lessor standpoint, a lessor is not required to make an adjustment. Why? Because the accounting adjustment what we discussed for the lessor is by and large is same. So obviously from the date of transition, the leases in which lessor shall account those applying for the lease, it has to be from the initial application. So no major change is going to be as far as lessor is concerned. So that's all in detail about this lease accounting standard. We try to cover it off in a simplistic way. I hope you will enjoy this video, and I would look forward for your input and improvements that's required in the future videos. Thank you so much.